If you are one of the stock market freaks that can't resist himself from drawing a chart pattern such as ascending channel on even something like sky's lightning, then you've picked the right YouTube channel, because we are talking about the insanity of stock and crypto markets and also how to take advantage on this craziness that is going around. So welcome to Blockrevision channel and let's begin our episode. And right now let's get to market movers section and we are looking through economic calendar. As of yesterday we had data from New Zealand that were lower than forecast, so we can find that New Zealand is on the trajectory of getting a hike of interest rates at the end of the month as the economy is developing as forecasted, and government finds it as a reason for increase in interest rates. So the unemployment rate is lower, and employment change from New Zealand as well shows some strengths. So it's getting back to this 1% level. Let's look at the 3-year trajectory or 10-year. The 10-year shows that we are in this pre-pandemic level. So New Zealand is slowly but surely getting out of the recession. Afterwards, on Tuesday, we had catering services PMI from China, where we have seen a boost and bring it back as higher after this recent June's lows, that we have nearly touched a boundary of economic growth that is projected at the 50 level. So right now we can find that due to a sharp and accelerated expansion of services activity and successful containment of recent uptick of COVID-19, we are still in this growth environment and the area of 50 for 55 that brings hopes of quicker recovery than it was recently forecasted. And on Wednesday we had some data from Euro area where retail sales month over month turned out to be lower than expected. We couldn't trail expectations as there are some serious concerns of next COVID-19 restrictions and also growing probability of lockdowns during this fall. So from 4.1 level we have dropped to 1.5. So with this also threats of pulling out some stimulus, and the economy that shows also a slowdown is the US, which ADP employment change gauge has indicated half what it has indicated last month. So there is a softest pace of job creation since February, adding to signs of a slowdown in the labor market recovery as new COVID-19 cases surged across the country. So what about this hike in interest rates if the labor market is not prospering very well? So we can find there is some disparity in what Fed is going to do and what the economy turns up. So what the economy shows up. We can also find very good earnings data as of yesterday. Alibaba, BP and Activision Blizzard, all of them have beaten the expectations by over 18%. And the chart I'm pulling up right now is how recently economists were missing the targets of the hard economic analysis that was covering topics such as labor conditions, housing, industrial performance, and we can find that as average missed expectations was of 22%. So we've got really accustomed to this higher and higher growth metrics, but with this pulling out of stimulus packages, things are getting a bit disenchanting. And right now let's get to economy view and discussing the shit out of the Fed statements, where Fed takes 84% of net increase in T-notes and bonds since February 2020, where Fed purchases plus incremental T-bill issuance is summing up to 91% level. So Fed, it turns out that Fed is buying all the issued debt. So why do we really need taxation then if we can fund everything with government's printed money? And also let's take a look at tips where Fed has assumed that he purchased almost 200% of the tip issuance during the period. So undoubtedly it's just to manage the break-even rates. So the US central bank now owns 22% of the tips market. So probably we can come to an takeaway why BlackRock decided to short tips after cashing in on inflation surge. So it probably knows something that we didn't know. So we know that BlackRock is nearly like a acquaintance to the Fed. So probably this inflation expectations may go lower, not really due to some sentiments around the traders or speculators, but even by this manipulation of the tip market that US central bank may go through. We can read that US household debt rose at the fastest pace since 2013 in the second quarter, driven by a mortgage boom as Americans took advantage of low borrowing costs and sought more space to work from home. So mortgage debt alone surpasses $10 trillion in 2020 with an annual change of 0.73. So then an increase in this area is a good thing overall. The rise of mortgage debt is an indication of recovery in the housing market. However, and this higher debt also indicates falling household financial savings rate due to the rise in consumption and health spends. So what's next with this housing market? As the next wave of the variant may hit the economy, we would need to be prepared for resulted in significant deposit outflows from banking system. Everything depends on the strength of this Delta variant turning up. So it's definitely as of note to just track how this situation develops. Old school contrarians are trying to aware us of a possible drop in a stock market. So S&P 500 hasn't had a drop of 5% in recent 9 months, and almost 2/3 of clients in a JP Morgan survey said that they plan to add to stock holdings in the coming weeks, and the Bank of America gauged that plots levels of strategist optimism to a post-crisis high, which the bank says has left it close to triggering a contrarian sell signal. So we can find that what Michael O'Rourke has said, that the exuberance remains pervasive on the markets, and this triple peaks theory of peak earnings, peak economic growth, and peak stimulus is something that we should be cautious of. However, whenever the headlines on the Bloomberg says we need to be afraid, that still with low probability as a market top. However, what may make markets to feel this force of gravity again, whereas companies still carry sizable cash during what they have accumulated last year, and I would say the personal savings of investors that may boost another round of investing. There are no specific signs as of slowing down yet. However, personal savings rate as of recent has diminished, but we can find that households squirreled away extra government aid and right now are still at higher level than it was pre-pandemic times. So overheating sentiment used to be used as a predictor. However, it has been recently, the efficacy of this strategy has recently dimmed as investors have grown accustomed to buying every dip. Quickly going through index outlook, and we can find that we have just formed a bottom on this recent highs of S&P 500. It means there's higher chance of getting to the north direction than rather to the south. So right now the real probability of tumble from here is very low, as we have just stayed and defended this area and preparing it as a base for future possible growth. During recent months, we've seen a fierce battle between lots of institutions such as Venek, Fidelity, Valkyrie, Wisdom Tree or Goldman Sachs in order to file an application for Bitcoin ETFs. So all of these efforts were holding up by those regulatory framework that couldn't really keep up with demand for Bitcoin ETFs. If Bitcoin ETFs would be introduced to the market, that would be the most tracked type of asset among all, even S&P 500 and Russell 2000. So we can find right now that we find that Sachs-Gensler signals pathway for a Bitcoin ETF, but with tough rules. So there are at least 7 SEC initiatives looking at different crypto issues such as initial coin offering, trading venues, stable value coins, and they need to ensure whether cryptocurrencies are not securities. I wouldn't be afraid of Bitcoin not being a security because it doesn't has any issuer, any specific issuer of new coins, and this mechanism of Bitcoin infrastructure doesn't bring any specific resemblance to the stocks that are traded on a stock market. However, about the other altcoins that Gensler is focusing on, there would be different topic that may brings us some other conclusions as of chart. So Gensler also signaled an openness to an ETF focused exclusively on Bitcoin futures, which are offered by CME Group and require that investors put down substantial margin to trade. So there are some advantages of introducing an ETF in spite of what mutual funds offering are so far in terms of Bitcoin related products. So mutual funds as of merit may be closed, of course, and ETF can't, so it brings a point of security over here. And even if Bitcoin ETFs will lay its price on futures, it will still introduce a layer of complexity, despite what other people may claim. So future-based ETFs are maybe not unlikely, are not likely to perfectly track the spot price of Bitcoin due to, for instance, taxation issues. However, that may be a first positive step towards physical Bitcoin ETF approval. So the question that turns up is when we would see those ETFs to be introduced by SEC. I don't find this as to be very, very close as of right now. The possibility is this one to be introduced at the end of this year, but the higher chance of putting this to banks and funds offers is the next year. So with this claims of FTX CEO that says regulatory clarity for crypto would take 3 to 5 years, it just brings us to take away that whereas Bitcoin might be regulated maybe during next 12 months, the other altcoins may wait much longer. Right now, I don't find the crypto market to be pushed by any of the news of the possibility of introducing ETFs during next 3 months or maybe even 6, but it's something to watch and definitely focus on regarding your trading plans. And getting to this Bitcoin and crypto sentiment right now, we are still in the bearish environment before the possible cross of 42k USD. So right now we can find there's a much healthier spot-driven recovery than its futures-driven recovery, where we are in a backwardation time. So it means that futures are traded lower than spot exchanges. So it means the interest of Bitcoin open interest is still at a very low level, despite recent surge. In terms of recent surge, let's look at the flows of Bitcoin price, flows of Bitcoin tokens, and we can find that fund flow ratio for exchanges is decreasing, but tokens transfers has increased. So it means that nearly 90% of transactions are right now happening outside of the exchanges. That's possibly OTC deals, but who really from insiders would buy this type of asset on the local highs? That just might be a local manipulation of a price in order to just get wrecked some of a short-term speculators. So it's just maybe an accidental abnormal price movement that maybe very quickly get over. So today's most important chart for trade idea section is Roblox. Roblox that has right now been in this descending wedge pattern that during the bull market gives a high possibility of breaking out to the north. So high volume right now is expected in order to send it higher. Otherwise, I wouldn't take this trade. We are especially on this support level that previously has been as of resistance, and we can find that we have formed this bull candle right now that may bring a higher upside from here. So a possible trade to take is to take a position after this after possible breakout to 83 US dollars, and with a possible stop loss just below this higher boundary of descending wedge. So the stop loss will be at $78 with a possible breakout level to $94. So it's nearly the key risk reward ratio is at 2, so it's not very high, but still affordable. So Roblox is that online game platform that and also a creation system developed by Roblox Corporation, and recently it has generated lots of interest that brought us to some good data from active users that has surged during the last year over 28%, and right now it's generating surge of interest on and on. So in order to keep growing, the company is trying to target the older players, but right now the competitiveness in that space is quite fierce, and despite this ARK Invest Katie Wood buying over 150,000 shares of Roblox at these levels of 75 bucks, so that also brings some credibility for this trade to take around with the entrance about $83. Getting back to fundamentals, we can find that cash to debt versus industry, equity to asset and debt to equity are not at highest levels. However, this stock is still very reliable with a great prospect of future growth. Analyst estimates are at about 90 bucks, but right now what we could find here is that the profitability rank is very low because it's a very new company, so it's around and during this meme stock sentiments still to maintain. I guess Roblox is still a good bet. So the Finviz brings us that earnings per share for next year is projected to be at 5%. The best for the growth stocks is to get this measure at about 15-20%, and earnings per share this year is at the very high minus. So the company is not profitable, but in this environment of favoring growth stocks, Roblox is at and favoring meme stocks, Roblox is in the favorable position. Okay, so that's it for today. Thank you very much for watching. If you want to start a discussion around any topics brought today, just get to the comment section below and give me a like if you have enjoyed the content I brought. Thank you very much for watching, and see you tomorrow.